You twist the key, step into a silent, marble-floored foyer, and feel the cold before you feel the space. Outside, the sky is a dull sheet of pewter, wind worrying the palms, drizzle threading down the glass like nervous sweat. The kind of weather that makes even a multi-million-dollar view look smaller. You can almost hear the house listening, because it's been listening for weeks, waiting. No footsteps from buyers, no laughter from open houses, just the low hum of uncertainty. And then your phone buzzes. Another price cut, another back on market, another deal that evaporated at the inspection table. In 2025, California's luxury housing market isn't just cooling. Parts of it are unraveling, crumbling under higher rates, insurance shocks, and a buyer class that suddenly knows it can say no. This is Genspark Real Estate Research, and if you want data-first breakdowns with zero fluff, subscribe now, because we're starting a countdown, and the next 10 stops only get darker. Number 10, Santa Barbara, California. You roll in under salt-heavy air and soft coastal light, the kind that once made every stucco wall look like a postcard. Santa Barbara's reputation has always been safe luxury, a refuge from LA chaos. But now, the calm feels staged, because the market is quietly losing its grip. Back in 2022, trophy properties pushed into the stratosphere, with high-end deals routinely clearing $5 million as remote work and celebrity demand spiked. The city sold a story of permanence, ocean breezes, limited land, and a gated calm that money couldn't easily replicate. In 2025, the numbers turn concerning. Local MLS reports indicate the luxury segment's median sale price is roughly $4.6 million versus about $5.4 million at the 2022 peak, a decline near 15%. Zillow figures show price per square foot down around 8% from peak pockets. Realtor.com trend data points to longer marketing times, with days on market stretching into the 70-90-day range for premium listings. Redfin-style market tracking shows inventory up about 25% year-over-year in higher price bands, and roughly 30% of active luxury listings carrying at least one reduction. Sales volume in the 3M Plus tier is down about 18%, and rental vacancy for high-end single-family leases has loosened near 6%. Source: what's driving it is straightforward. Jumbo financing is more punishing at today's rates. Insurance has risen sharply in wildfire-adjacent zones, and top buyers are demanding perfection: new roofs, hardened landscaping, turnkey interiors, or they walk. As you leave Santa Barbara behind, the market feels like shoreline sandstone, still beautiful, but eroding grain by grain, and the outlook is softening. Number 9, Napa, California. You enter Napa through vineyards that look serene from the road, rows of winter vines like stitches across dark soil. Napa used to feel immune. Wine country wealth, second-home glamour, and a steady stream of out-of-area cash. But the mood has shifted, and the luxury market is starting to sag. In 2022, estate demand surged as buyers chased privacy and lifestyle, with high-end medians pressing above $1 million and premium hill properties leaping far beyond that. The growth was powered by pandemic-era relocation money, stock gains, and the fantasy of living like vacation. Now it's troubling. Local market roundups show median pricing around $925,000, with far longer market times, about 100 days in some 2025 snapshots. Price reductions have become common. Local agent reporting has cited figures near 47% of listings taking cuts, signaling sellers overshot reality. Sales-to-list ratios have slipped toward roughly 96%, and inventory in luxury bands has widened as second home owners test the market. Zillow-based estimates show softer year-over-year appreciation, while Redfin-style tracking indicates fewer bidding wars and more contingency-heavy offers. Investor interest has faded, with purchase activity down an estimated 20% from 2021 highs, and short-term rental performance is less reliable as regulations tighten and demand normalizes. Source: the causes bite hard. Insurance and wildfire risk premiums are rising, tourism-sensitive income is uneven, and buyers are no longer romantic. Every deferred maintenance item becomes a negotiation weapon. As you pull away from Napa, the market feels like uncorked wine left out overnight, still valuable, but losing its edge, and the next cities get worse. Number 8. La Jolla, San Diego, Hawaii, California. You crest the hill, and the Pacific flashes silver under a bruised sky. La Jolla has always projected wealth without apology, cliffs, coves, and homes that read like architecture magazines. For years, it was a belief system: coastal luxury only goes up. But 2025 is testing that faith. The peak years, 2021 into 2022, were fueled by cheap money, migration, and a frenzy for forever homes near the ocean. Buyers paid for scarcity and status, and sellers learned to price like gravity didn't exist. Now the data is alarming in pockets. Zillow reports broader California softening, and West Coast commentary shows price momentum fading in expensive coastal nodes. Realtor.com market trend reporting across the West highlights rising price reductions and stale listings. And in the luxury band, the behavior has changed. Days on market are longer, deals are more conditional, and sellers are negotiating again. In La Jolla's upper tiers, recent listing histories show repeated cuts, sometimes 6 figures at a time, while sales volume has slipped notably from the peak cycle. Redfin-style indicators suggest inventory is up meaningfully year over year, and the share of listings with reductions is pushing into the 30% range. Source: the drivers are brutal. Insurance and maintenance costs on coastal properties are rising. Rates punish jumbo borrowers, and high-income buyers are splitting time. Remote work didn't vanish, but it no longer guarantees permanent relocation demand. As La Jolla recedes in your mirror, the market feels like a cliff edge after rain, still standing, but slick, unstable, and one hard step from a slide. Number 7. Malibu, California. You follow the coastline where fog hangs low, and the ocean looks like hammered steel. Malibu used to be the ultimate scarcity play: thin strip of land, global prestige, and a buyer pool that treated price as a flex. But the luxury market is starting to hemorrhage time, and time is the first symptom of collapse. Malibu's pandemic-era peak around 2021-2022 was driven by remote work wealth, entertainment money, and a tidal wave of escape purchases. Buyers were paying for private beach access and the illusion that nothing could disrupt the dream. In 2025, that dream is cracking. Luxury listings are lingering, and major properties are cutting, sometimes dramatically. The wider LA luxury ecosystem has seen attention-grabbing reductions, with prominent listings chopping tens of millions off asks, signaling that even the top is negotiating with reality. Market narratives describe a frozen feel in parts of the luxury sector, where sellers want yesterday's price, but buyers want today's terms. Days on market have stretched into months. Sales volume is down from peak activity, and the percentage of listings with reductions is elevated. Pricing power is evaporating, especially for homes with deferred maintenance or complicated coastal exposure. Source: 2 factors dominate: insurance costs tied to wildfire and coastal risk, and the entertainment industry slowdown that's made high-end buyers more cautious. When the wealth engine hesitates, Malibu feels it immediately. As you leave Malibu behind, it's like watching a luxury yacht drift without wind. Still expensive, still shining, but no longer moving forward. Number 6. Beverly Hills, California. You glide past manicured hedges and gates that hide more than they reveal. Beverly Hills used to be pure confidence, where a listing price was a statement, not a question. But now the luxury market is slipping into something more unsettling: public price cuts, longer waits, and sellers quietly blinking first. The 2022 peak was powered by cheap jumbo money, global capital, and a steady stream of entertainment and executive wealth. Trophy homes were treated like collectibles, and the top end relied on the idea that prestige cancels out market gravity. In 2025, the signals turn brutal. High-profile mansions have taken extraordinary reductions, including one mega-listing that cut its ask by tens of millions, broadcasting desperation into a market that once pretended desperation didn't exist. Reports on LA's luxury scene describe houses sitting for months, with buyers demanding concessions, repairs, and appraisal buffers. Days on market in the top tiers have lengthened, sales volume is off peak pace, and repeated relistings are becoming more common. The market's psychology has flipped. Instead of fear of missing out, buyers now fear overpaying. Source: the drivers are sharp and specific. Industry income uncertainty, higher carrying costs including property taxes and staffing, and jumbo rate math that makes even wealthy buyers pause. Luxury doesn't disappear. It just negotiates harder. As you exit Beverly Hills, the market feels like a chandelier with cracked crystal, still glittering, but one vibration away from shattering. If you're finding this data-driven analysis useful, like the video and comment which city surprises you most. Your engagement helps us continue this research. Number 5. San Francisco, California. You arrive under low clouds that swallow the tops of towers, the air sharp and metallic. San Francisco's luxury housing was once the crown jewel of tech wealth, an asset class disguised as real estate. But now, the market's confidence is wobbling, and the cracks are spreading. The peak cycle around 2022 was fueled by equity windfalls, IPO-era bonuses, and a belief that the Bay would always lead. Luxury buyers paid for views, proximity, and status, and sellers priced as if demand was infinite. In 2025, the situation is devastating in segments. Redfin's broader market commentary has emphasized rising inventory, and luxury behavior shows more listings lingering. Public reporting notes that citywide medians have been volatile, and the upper tiers are sensitive to tech pay cycles. Price reductions have become more visible, days on market have stretched, and buyer leverage is growing. The condo side has faced additional pressure, while single-family trophy homes are more resilient but slower. The result is a luxury market that no longer feels liquid, one where sellers wait, cut, relist, and wait again. Source: why it's happening. Hybrid work reduced urgency to live near offices. Tech layoffs shook confidence, and high rates punish financed buyers. Even cash buyers are acting like analysts now. As you leave San Francisco, it feels like fog rolling through an open window. Quiet, persistent, and chilling the entire room. Number 4. Palo Alto, California. You enter Palo Alto where the streets are clean, the trees are perfectly spaced, and the wealth is almost silent. This was the market that people called bulletproof. If a house didn't sell in a weekend, it felt like a glitch. But in 2025, the glitch is becoming the system. In 2022, Palo Alto's luxury prices were supercharged by venture capital, stock-based compensation, and a relentless fight for top school districts. The scarcity was real, and so was the bidding war culture. Growth fed on itself. Now it's catastrophic by luxury standards. Even as Redfin has highlighted broader inventory increases, the ultra-high end is showing fatigue. Buyers are demanding inspections, credits, and price realism. Days on market are longer than the region is used to admitting. Price reductions, once rare, are becoming more common in the 5M+ tier, especially for homes that aren't turnkey. Sales volume is lower, and the price per square foot gains of the pandemic era are no longer guaranteed. The psychology has shifted from buy at any cost to prove the value. Source: the factors are crushing. Tech compensation volatility, the hangover from 2021-2022 pricing, and financing costs that turn even wealthy borrowers into skeptics. In Palo Alto, sentiment matters, because everything is priced on confidence. As you move on, the market feels like a code base full of hidden bugs, still running, but increasingly unstable under load. Number 3. Santa Monica, California. You step into Santa Monica with ocean air and city noise colliding. Luxury condos near the beach, designer storefronts, and the echo of pre-pandemic swagger. For years, this was LA's walkable luxury, where high prices felt justified by lifestyle. But now, the market is collapsing into hesitation. The peak around 2022 rode the same wave. Low rates, remote work, and a buyer class paying for access, beach, restaurants, proximity to tech and entertainment corridors. In 2025, the deterioration is severe. Wider luxury market reporting describes buyer resistance and sellers using creative tactics to move product. That's a symptom of friction. Too many expensive listings chasing too few confident buyers. Days on market have expanded, price reductions are common, and the condo segment is particularly sensitive to HOA fees, building assessments, and insurance costs. Sales volume is down from peak, and price per square foot growth has cooled. When luxury buyers can choose between multiple similar properties, Santa Monica's market stops feeling scarce. Source: the contributors are concentrated, high carrying costs, HOA and maintenance burdens, and a more fragile high-income job environment in entertainment-adjacent sectors. The lifestyle is still there, but the urgency is gone. As you leave Santa Monica, the market feels like a tide pulling back. Quiet, revealing what was hidden, and setting up the next doodah. Number 2. Truckee, North Lake Tahoe, California. You climb into the mountains where the air thins and the pines stand like dark witnesses. Tahoe luxury once looked invincible. Second homes, ski access, and the pandemic escape hatch for Bay Area money. But in 2025, this market turns ruthless, because nature and insurance have entered the balance sheet. The peak in 2021-2022 was powered by remote work freedom and cash-heavy buyers who wanted space, snow, and distance from cities. Limited inventory pushed prices up fast, and sellers assumed demand would stay permanent. Now it's terrifying. Insurance is becoming a deal term, not an afterthought. Reports focused on Tahoe wildfire insurance describe how premiums, deductibles, and coverage exclusions can reshape affordability and even kill transactions. That reality ripples through pricing. Listings sit longer, buyers demand larger discounts, and the market punishes anything not defensible or upgraded for fire mitigation. The slowdown shows up in longer marketing times and more reductions, especially at the high end where carrying costs are already enormous. When insurance becomes uncertain, liquidity evaporates, and luxury depends on liquidity. Source: the factors are brutal and simple: wildfire risk, insurance instability, and second home demand that is far more optional than primary home demand. A luxury ski cabin is the first thing buyers delay when the math turns ugly. As you descend from Tahoe, the market feels like melting snowpack. What looked solid all winter suddenly turns into runoff, fast and unstoppable. Number 1. Bel-Air, Holmby Hills, Los Angeles, California. You drive through winding streets where gates loom like fortresses, and the city lights glitter below like a separate universe. This is supposed to be the safest corner of American luxury real estate where money hides when markets burn. But in 2025, even these hills are cracking, and the collapse is loud enough to make headlines. The peak around 2022 was fueled by cheap debt, global wealth inflows, and a status race where pricing wasn't anchored to comps. It was anchored to ego. Mega mansions listed like private islands, and the assumption was that eventually someone would pay. Now it's outright devastating. A Bel-Air mega mansion reportedly took a staggering $40 million price cut as the luxury market slowed, a brutal public admission that the old numbers don't clear anymore. That kind of reduction is not a trimming. It's a collapse of leverage. When trophy listings cut that deep, it signals wider distress, longer days on market, fewer qualified buyers, harsher negotiations, and sellers discovering that rare doesn't mean liquid. The top tier is bleeding confidence, and once confidence evaporates, pricing follows it down. Source: what's driving the wreckage? Jumbo. Financing costs, higher property and staffing overhead, and a luxury buyer pool that has turned clinical. In 2025, even billionaires demand a deal, and they have time. As you leave Bel-Air behind, the market doesn't just soften. It collapses like a hillside after a storm, and the outlook is clear. The reset is real, and it's underway. The countdown tells one story. California luxury isn't immune. It's simply late to react. From coastal calm to mountain risk zones to LA's trophy hills, the same forces keep tightening. Higher rates, rising insurance pressure, and buyer confidence evaporating in real time. This isn't a headline cycle. It's a liquidity crisis at the top, where listings linger, cuts stack, and yesterday's new normal crumbles under today's math. If you're buying, you need discipline. If you're selling, you need realism, fast. Subscribe to Real Estate Research, like the video, and comment which market you want us to dissect next, because the next shift won't announce itself politely. Until next time, stay sharp, stay data-driven, and I'll see you in the next breakdown.